I have a pen. I have a pen. It was,
Might have.
yeah, that's perfect. Yeah. That's good. Just for studies, really.
Can people online hear us well? Or hear us? Maybe not. The mic is going up and down as we speak. So right?
Maybe ask in the chat.
Maybe ask in the chat. Yeah, thank you.
But you have
No.
to ask.
Sorry?
Let's be honest. Honestly.
How long do you want to speak for?
How long should I speak for? Really,
That's enough. Half an hour, 15 minutes?
40 minutes, yeah?
Yeah. Good time for question and discussion. Yeah?
Yeah.
So we're ready whenever you are.
Okay, I'm ready.
Okay.
So no one has answered yet. Didn't hear us. We wait for them to reply, or I guess.
So can we start and you carry on fiddling?
Okay, some people are saying you can hear us.
Okay, good. Excellent. Great. Okay.
So,
Then
welcome everyone to this final CITYPERC seminar of this semester with Johannes Petry from Goethe University in Frankfurt. And this topic, very interesting and very timely, Wall Street, China, and the remaking of capitalism. So all yours, Johannes.
okay. Thank you, and thanks for the invitation to be here. So what I'm presenting today is a really new project. It's in a very weird state. On the one hand, I've written a paper on water in China in the most recent era of geopolitics and the US trade war. It was published a few months ago. So that is very polished. It's an idea for a book as well, and I'm working on the proposal at the moment, so that's really drafty. The first time I actually put this in a more coherent way, what I want to say in the book, was in the ground application. And I already did like 50 interviews this year on this in Shanghai and Beijing mostly. And so I know something is happening, but I haven't really analyzed it systematically enough yet. So take all of this with a pinch of salt. It's rather an argument that I'm presenting, and it would be great to get your feedback if it actually makes sense. All right. So the idea here is really to look at, this relationship between these three actors, right? Or entities: Wall Street, i.e. private global finance, China, and global capitalism. All right, so this is how the Chinese financial center in Shanghai looks like at the moment, right, in Pudong. It's now China has the second largest equity markets in the world, the second largest bond market, one of the largest futures markets, has thousands of listed companies, and really has become a global financial powerhouse, right? I mean, even leading in areas such as kind of mobile payments and so on. This is where it is now, but this is how exactly the same site looked like 30 years ago, right? This is 1995, and there was no financial system in China, right? I mean, capital markets were only established in 1990, and I mean, banks didn't know how to price risk. They were really policy banks. China was transitioning from a planned or a command economy towards a more market-based one. And how do we get from here to here, essentially? And what I'm arguing, or the argument I want to develop, is that actually a lot of this has to do with Wall Street, right? With these institutions that we all know, Goldman, New York Stock Exchange, BlackRock, and so on. And what I look at is kind of these three entities, right? We know a lot about, in the literature in international political economy, about a relationship between global capitalism and Wall Street, which broadly speaking is kind of Wall Street has a liberalizing effect on global capitalism, right? The end of Bretton Woods, the reemergence of global finance, the solution of capital controls, the structural power of investors, the private authority of rating agencies, index providers, and so on. this whole debate about convergence towards a more Anglo-American way of doing finance, that is kind of how this debate is usually kind of concerned, what the debate is concerned with. On the other side, we have this relationship between China and global capitalism, right? So, and here we often think of China having a deliberalizing effect. On the one hand, yes, China has changed itself and it's becoming more liberal, but never as liberal as kind of other kind of economic systems were. And you have state-owned enterprises. The state has a very important role, right? They've internationalized, they've exported some of these kind of logics as well internationally. So that's kind of a first wave of deliberalization, and the backlash against China, right? The second order effect with the US, Europe, and so on becoming more interventionist as a response to China's rise. So overall, this more deliberalizing effect. But what we don't really know is what the relationship between Wall Street and China is. We have lots of research on kind of China's banking, and so on, but we're really looking only at China, but we don't really look at this relationship. And I would argue there's kind of three kind of gaps in the existing literature. One is that while we often talk about diffusion when it comes to Wall Street and its kind of impact on other countries, maybe we should talk about how it adapts to non-liberal systems, right? Global finance could operate differently under certain conditions in countries such as China, or Saudi Arabia, or Russia. Then we really don't know a lot about kind of global financial firms' impact when it comes to China's rise, be it in the financial realm or in kind of broader economic terms. And here the question is, well, actually, had Wall Street a role in making China great again? And I mean, there is some work on global finance in China, right? There's individual bits and pieces. Some people may have worked on kind of private equity, Kimberly Chung, consultants, and so on. But it's really, there's no kind of systematic history of that relationship. And that's what I want to do with this kind of project. So the question that guides us is, how has the evolving relationship between Wall Street and China shaped China's financial and economic rise? But looking at three different things. First, how is Wall Street actually operating in China, right? So whether and how and why then have kind of leading global financial firms accommodated China's kind of state capitalist model? Do we see that happening? And if so, how is that process structured and why do we see it happening? Then what's the impact on Wall Street on China's financial system? Has it contributed to China's financial development, making it more sophisticated, more international, and so on? And thirdly, is there a broader impact of Wall Street on China's economic rise? And the hunch that I have and the argument that I want to develop is that what we saw in all of these kind of was a Faustian bargain, right? It was giving access to China in a very limited way, but it was given access and could make a lot of profit in that process. But in return, this was a very kind of structured way of accessing China, which contributed to kind of the knowledge transfer, essentially, right? And teaching basically how to do finance, but adapted in a Chinese way, and really also enabling the economic rise through certain means. So the idea is to kind of look at, we have these kind of two different entities that function according to different institutional logics, right? In Wall Street, this is the driving force of neoliberal globalization, right? So here we have kind of, would assume that we have kind of more these liberal dynamics at play. In China, it's an economic system where the state plays a large role. So how can we kind of bridge these two ways of operating finance, really? And what I'm proposing is to look at three different mechanisms to look at these kind of lines of inquiry, right? First, to look at kind of when it comes to how does Wall Street operate in China, the argument is that what we see is institutional adaptation, right? So Wall Street is adapting its practices when it comes to China so that it is able to make money in China, because that's kind of what drives its decisions, adapting to make money according to that execution context in which it's situated, because it doesn't have enough power to kind of force adaptation the other way around, which we would see in other cases. Right? Secondly, what we see is a learning process, and there's this concept of situated learning, which basically argues that learning is very much about social interactions, right? And not so much about the transfer of kind of IP and so on, or kind of not a, if it's a capital-intensive process, it's about human and social capital. And it is an embedded learning process because, again, here the institutional environment structures that learning process. And I'll talk about this in a second as well. So what we see is that the way how basically Wall Street was able to operate in China facilitated that kind of learning. And thirdly, what's the broader impact on the economic transformation of China? And here the argument is that essentially Wall Street functions as an enabling infrastructure, right? So if we think about kind of what is the role of finance in an economy, it is kind of enabling other economic transactions to take place through the dissemination of credit and so on. And here my argument is, look, Wall Street actually was very fundamental for a lot of the things that we saw in China's economic rise beyond finance. And that's the most speculative assumption that, yeah, I'm trying to kind of analyze more systematically as well. Now, to the methodology, how I do this is I want to look at this from the 1990s onwards until today, basically. I look at three different aspects of finance in China. So first, look at the corporate banking that we saw in the 1990s and 2000s, then investment banking in 2000s, 2010s, and then asset management, and then kind of this more recent area of kind of geopolitics, geopolitical contestation and backlash against China, which also affected Wall Street considerably. And I mean, and all of these processes have kind of run through in some way or another, but these are the phases where they were most pronounced, really. And the way I want to do this is kind of look at using different methods when it comes to kind of institutional adaptation to really look at the corporate histories of Wall Street in China, so look at the 50 largest Wall Street firms, how have they operated in China, what kind of entities did they have, were they minority-owned joint ventures, or were they minority partners in joint ventures, majority-owned, which kind of licenses did they have, what kind of business areas as well, what were they able to do, what were they able to do, what were the partners, how they developed over time, what kind of profit they made, and so on. Also look at kind of financial data on what kind of profits they made from China, right? I mean, you can look at all the M&A data, for instance, or this is what I think I'm going to do, look at all the M&A deals, who are the underwriters, how much money did they actually make in the process, especially listing Chinese companies in New York and Hong Kong and so on, right? Which was terribly profitable for them. Then kind of when it comes to, and I mean, these corporate histories are important for all the different arguments. Then also looking at kind of the flip side of, has this kind of profit making shifted, right? And now Chinese firms more able to facilitate these things, the internationalization of Chinese firms, their listings, and so on. So has a learning process taken place when it comes to, are they actually eating away at the pie of Wall Street when it comes to Chinese companies? Which again would be kind of financial data via Bloomberg and so on. And then also looking at kind of the social dimension, right? In how far do we see executives from that are currently leading Chinese financial firms, were they trained at Goldman, at UBS, at JP Morgan, and so on? And I mentioned I already did some interviews, actually only like this year mostly. And they seem, like all of these things seem to matter. But I want to look at this more systematically. And when it comes to about the enabling infrastructure, it's really three things I want to look at. First of all, how important was Wall Street in getting money into China, in terms of facilitating inward FDI? In how far was it important when it came to the outer expansion of Chinese firms? especially in 2010s, and how far were they important in kind of bringing global capital into China. And was that channel into certain strategic sectors as well. So, and interviews are super, I mean, so this is kind of the scaffolding, I would see it, this kind of more systematic analysis. But this really, I think, only comes to life by speaking to people that actually were in the room or part of that process. And this is kind of where I came from originally, and now I'll expand it a bit more systematically. But I already did the corporate histories to a large degree, have some of the kind of social network analysis, some anecdotal evidence at least, and did 50 interviews. And just to give you an overview, some of the people I talked to, I mean, usually they're kind of people like chief economists, executive directors, China CEOs, country managers, and so on, of institutions like UBS, Standard Chartered, BNY Mellon, Allianz, Commerzbank, BNP Paribas. And just as an example, like these are some of the details of these people, where you can actually see what I mean. There's one guy, actually he's Chinese, and he moved to his family as a child, and then he went to the Marines and to the Peace Corps, and then he worked for Wachovia, and then was a country director of Wells Fargo in Shanghai for like 15 years or so. So just, and I think that's quite, I mean, it's interesting to see kind of how these people could have moved around as well. So these are kind of the interviews. Okay, so now I want to walk you through the argument that I've developed based on these initial findings. All right, so first we have the kind of corporate banking era, right, the 1990s and 2000s, which was really very much linked to China's entry into WTO from 2001 onwards, China becoming the factory of the world, and all these kind of Western corporate, kind of Western institutions, they kind of went in as corporate, commercial banks originally, starting with the banks from Hong Kong, like HSBC, Standard Chartered, the Japanese banks, quickly followed by the Europeans and then the Americans. And how I see the bargaining unfolding is really Wall Street had access to China, right? They could open local branches, only wholesale business really, that they couldn't do a retail business, and that was actually quite intentional. So they could do retail, but they would have to apply for every single branch in every province or every municipality individually. So they never did that really. But that also meant they had a very small capital pool, so they were a threat to the Chinese banks as well. And what they really did was, so that was kind of one part of the access. They could operate independently with a small capital pool, or they could become strategic partners for Chinese banks, especially after the Asian financial crisis. A lot of them had to be recapitalized and actually got this huge capital injection from Bank of America, JP Morgan. So that was kind of what Wall Street out of it. Actually, they sold these stakes in the financial crisis and made a lot of money. Because they had to sell all these non-essential businesses, right? Like also the index business, iShares, and so on. So they also sold their shares in Chinese bank in 2007, 2008. So right, that was Wall Street. And the effect on the financial industry was actually they were really helpful in professionalizing Chinese banks. I mean, in the 1990s, the China Construction Bank was the China Construction Bank. It was a policy bank. They didn't have any risk models, nothing. They didn't know how to assess risk. They just lent money for construction. Until kind of, I think it was Morgan Stanley who got involved with them, and then kind of, there was a lot of kind of transfer that people were parachuted in from New York and London to help them actually develop these things in the first place. So you can see that the assets of foreign banks to China have actually risen quite substantially in the last 20 years. But interestingly, so have those of the Chinese. So actually the share of foreign bank assets in China has actually declined. It is less than 1% right now. So they've grown, but they've also helped the Chinese banks to grow even more, if you will. I mean, and there's lots of kind of what you also saw was kind of this professionalization of the banks, right? That happened in the process. And it had a broader impact on the economic development is really bringing in multinationals, or rather accompanying multinationals when they went to China, right? So there is this kind of book by Patrick McGee on Apple in China, right? It was published early this year, which is really interesting because they talk about the hugely important role, or he talks about this hugely important role that Apple had in facilitating the development of China's electronics industry by training these hundreds of thousands of people. But Apple also needed a banker in China. I mean, they expanded rapidly in a country with currency and capital controls and a very complex regulatory environment. And their bankers were Bank of America and JP Morgan, right? And they really helped them to set up the factories, the payrolls, to get investment in and out, to expatriate money, and really smoothing the wheels of commerce, if you know. And it's the same with like Volkswagen, where you had Dresdner, Commerzbank, and so on. So essentially, all these multinationals had their main partner bank from home, be it Japan, be it Germany, be it the UK, be it the US. They helped them in their business in China as well. And this doesn't mean that Apple wouldn't have made it in China, right? But I think that huge rise and this quick development that we saw would have not been possible without someone really helping them to actually facilitate the financial side of it. Because they didn't trust the Chinese banks, and the Chinese banks also couldn't do it in the 1990s or early 2000s. All right. Second period is investment banking. And here we have this kind of era of the 2000s, 2010s with these kind of huge IPOs in New York by Chinese, both SOEs and private firms. And this overseas expansion where, especially in the 2010s, Chinese companies bought up all these companies in Europe and the US. They had kind of huge outward FDI flow back then. And foreign investment banks went into China mostly from 2005 onwards. So we had, in 1995, there was one kind of pilot project, again, kind of policy experimentation, a very kind of Chinese thing to do. Let's start with one bank and see how it works. And if we're happy with it, we can extend that. So what they did in 1995 is Morgan Stanley and China Construction Bank set up a joint venture controlled by China Construction Bank, CITC, which is now the not largest, but so best Chinese investment bank. Not largest by assets, but in terms of business and M&A deals and so on, and IPOs, they're the largest Chinese investment bank by far. And it was China Construction Bank, right? It didn't know how to do an IPO or value bonds and so on. It was all kind of Morgan Stanley that helped them do that. Again, the way the access was structured was largely through joint ventures in this era, right? So you didn't have these strategic investments anymore, but rather you had these joint ventures that were formed, which were usually kind of, I mean, they were always, until the 2020, they were minority-owned joint ventures. So essentially, Chinese partners had all the power. And what you really saw was there was kind of these efforts of kind of helping the Chinese financial community to actually learn how to do things. So what you see is that like the people from CICC, right, they learn from JP Morgan, others learn from Morgan Stanley, others learn from JP Morgan, from Nomura, from Deutsche, from Barclays, and so on. And then these people who were trained there actually then became the CEOs of the Chinese brokers and investment banks. So you can see like this movement of people from kind of these Wall Street roles to these kind of Chinese roles and taking that knowledge with them, basically, also taking teams of people with them. Originally, there were a lot of foreigners here in this kind of joint venture, and they became increasingly replaced by the Chinese nationals who, I mean, UBS China has, I think, 600 people, but there's maybe 10 foreigners now. It used to be like 50-50 almost. But now, yeah, I mean, so it's basically you have a lot of kind of learning going on here at this as well. And they learned how to do M&As, how to structure IPOs, And the impact on Chinese capital is also interesting because all the Chinese SOEs, hugely wasteful companies, right? I mean, you had this 1990s period where they're basically zombie companies, and they were actually, and one of the reasons why the stock market was created in China was to make them actually viable commercial entities, or semi-commercial entities. They always had a kind of state objectives to fulfill, but they needed to be commercially viable as well. So what we saw was kind of that all these SOEs were listed on the Shanghai Stock Exchange, in Shenzhen, secondary listings in Hong Kong, New York, and so on. To give an example, right? I mean, here are some of these things that we see. Right? This here is a Petry China IPO in 2007, I want to say. Back then, the largest IPO in the world. And was done by UBS. And UBS did this with 3 fax machines, because that's how it worked at the time. But actually, the guy who ran UBS at the time, Daniel Saylor, but he was a options trader from Chicago, from Midwestern guy, options trader from the Chicago Feds, who then started working in the derivative business for UBS and then built up their Shanghai operations from 20 to 500 people at the time. And he had an office at the CSRC in Beijing, right? That's how close the contact was, because there was also a lot of kind of interest by the Chinese regulators to actually learn from these institutions how to kind of organize markets and so on. It was always adapted to a Chinese context, right? And they learned from kind of different failures that were made, especially after 2008, after the financial crisis. They were really reluctant to become more American, if you will. But even before, there was always a hesitancy to actually just take this and adopt and put it into China. We're always going to adapt it within this kind of state capitalist logic of how the system operated. 2014, another largest IPO in the world by Alibaba at the time in New York, again facilitated by the likes of Goldman and so on. Or here, one of the largest mergers and acquisition by a Chinese company abroad, which was Chem China, who bought Swiss Syngenta, right? The agro business. And here, this is interesting because, half of the money came from ICBC and other Chinese banks, but the other half of the money for the takeover deal came from ING, UBS, and so on. And they were actually the ones that helped broker the deal, right? Because M&A is about relations. You need to know the parent company. And what we saw here with a lot of these M&A transactions was that the Chinese partners, the Chinese company contacted the Shanghai branch of the foreign bank, said, look, we want to buy one of these companies, what do you think? They reported to headquarters. Headquarters talked with the other company, like, look, we're broken. And that was how total actually worked very often, right? Because the Chinese banks have no reputation outside of China, so they could not do these deals. So actually, kind of the Western banks facilitated a lot of that. And you can see the market cap of Chinese companies on American exchanges kind of increased dramatically. And most of the companies that did the listings, right, JD, Alibaba, Baidu, Goldman's, Merrill Lynch, UBS, Deutsche. But more recently, what you could also see is that actually some of the Chinese banks have become more important as well in these listings. And these are New York listings, right? In Shanghai, in Hong Kong, we see this even more, that actually Chinese banks are pushing out the Wall Street banks to a certain degree in the IPO process, or at least, equal partners. But this is in New York. And here you can actually see that the Chinese are also becoming more important as well, which I think indicates some degree of, well, they can actually do it now, right, compared to 10, 15 years ago. All right, and this kind of third dimension is kind of the whole asset management, the capital markets beyond IPOs and M&As. And here we see China being more integrated into global markets with things such as the Stock Connect system with Hong Kong, the Bond Connect, the inclusions into the leading indices by MSCI, FTSE, the Bloomberg Bond Index, and so on. What we saw in this kind of process was a huge capital reallocation towards China. several $100 billion, right, in a 5-year period went into China as a result of these kind of new mechanisms that existed. And the Wall Street will also operate differently within China. So here, from 2020 onwards, full ownership was actually allowed at some point. So first, the 2010s, majority ownership of their joint ventures, and then full ownership from 2020 onwards, again, with a lot of kind of regulatory restrictions, and those who didn't behave previously don't get their license, whereas those who were good partners of the Chinese got the licenses much earlier and quicker. And here, what we see as well is that the industry in China, financial industry, is becoming more professional. It used to be, investors in China used to be a lot of mom and pop investors, right? 70, 80, 90% in the 2010s, in the 2000s of order flow came from kind of ordinary retail investors. It did not come from institutions. You didn't have a hedge fund industry. You didn't have high frequency trading and so on. You didn't have any kind of big pension funds or so. And what you see is on the one side, you have like 5% ownership of the stock market by foreigners, which isn't much, but it's much more than zero, right? And it does have a stabilizing factor, especially in some of the larger companies that are in the index where this is more like 15, 20%. But it's capped at 20%, right? Or 30. You can't own, like, foreign ownership can't be more than 30% in a company. So you have these kind of restrictions on the Chinese side that kind of structure that process quite deliberately in a very controlled way. On the other hand, you have kind of an increasing professionalization of the Chinese investor base. So the guy who followed Daniel Sanger at UBS, he was a Chinese national, grew up in a kind of village in Sichuan, was good at school, went to Tsinghua, then did an MBA at Carnegie Mellon. Went to Carnegie Mellon, did NYU Stern MBA, and then started working for Lehman and Merrill Lynch, and then UBS. When I talked to him, he was very pissed that there was this book, Dark Pools by Patterson, that talks about the development of high frequency trading in the US with Ireland and so on. And he was part of that group that wasn't mentioned in the book. But what he actually did was he brought the algos that he had developed for UBS in New York and brought them to China, and actually kickstarted the algo industry that we all had in China. An interesting one of the results is now we have DeepSeek, which grew out of one of these quantitative hedge funds in China, right? And I mean, it might have happened anyway, but I doubt it because that technology didn't exist in China. It was brought there by also essentially. Right, so you have professionalization of the investor base. You have now order flows like 30% retail, and most of this is more institutional. So you have a homegrown institutional investor base, and a lot of these people were trained at these other firms, at these Western firms. The impact on kind of Chinese capitalism was also interesting because there is kind of an integration of China into these global capital circuits, which had a few interesting kind of outcomes. One is there's a private pension pilot in China because the pension system, right, the state-run system is running out. They don't have enough money because it's a kind of pay-as-you-go system. The companies, especially private ones, are not contributing and can't really be forced to contribute, apparently. The familiar system doesn't work anymore because of one-child policy, right? Too many dependents that you have to take care of. So there is now a push towards establishing a capital market-based pension system in China. And UBS and BlackRock, and they're all very eager to participate in that. Right? And you have kind of things such as that all these kind of Western joint ventures and asset managers are actually quite important in bringing capital into China, especially in kind of sectors that the Chinese government wanted capital to flow into, right? So there was the star market that was established in, I think, 2020 in China, 2019, which was the NASDAQ of China. They wanted to have all these companies that are important for national development, / national security, in kind of AI, biotech, semiconductors, and so on, should be able to raise capital through this market. And it was the largest IPO market in the world for 2 years, in 2021, 2022, I believe. And interestingly, you have things like this, right, where the ICBC Credit Suisse joint venture tries to kind of bring these kind of foreign capital into these products together with kind of a California-based asset manager who has a kind of China ESG focus. So this I need to kind of look at it in a more systematic way, but I think there's something interesting there, especially when it comes to venture capital, right? I mean, there were these huge inquiries by the Senate and Congress into venture capital because they facilitated so much kind of deals in China and helped all unicorns to grow. So Sequoia was a good example, right? And they actually split their business into a China and US entity because of pressure from Congress, because they were really successful in China. But also in that process really helped certain Chinese industries to grow and mature. Another thing is that while they can't really compete that well in the domestic market, these kind of Wall Street firms, what they are very good at is this kind of cross-border business, right? Which we had before, bringing in FDI, facilitating outward M&A, and now these kind of QD licenses, which is the only legal system how Chinese investors can invest abroad beyond Hong Kong. They actually now have almost 25% share of the quotas, right? So their role really changed at some point where the state said, look, we'll give much more quota to these kind of joint ventures or kind of global companies, and they help allocate capital outside of China for our elites as well. All right, so these are kind of the three developments, and now everything is kind of falling apart in a way, right? Because Wall Street is really now between a rock and a hard place. On the one side, you have the US with an investment ban into companies that are linked to human rights violations in Xinjiang, or have some ties with the People Liberations Army, which now also includes Xiaomi, kind of smartphone slash robo-vacuumer slash EV manufacturer, and Cattle, the battery maker. Now they're also on these entity lists, right? You have these blacklist companies and congressional hearings. On the other side, Chinese finance has grown up, and it's really difficult now to actually gain ground or maintain market share. They never had much, but now this is actually a profit market really squeezed in China because the Chinese firms are actually competitive, even in Japan, even in Hong Kong, to some degree, even in Singapore, where they're kind of increasing internationalizing too. And I mean, you have more regulatory risk because of kind of data concerns from the Chinese government, because the Chinese government itself has also kind of shifted its stance of how it actually thinks about Wall Street and their way of doing finance. We were much more open to it in the 1990s. Now they still want international investors there, but they're much more hesitant to kind of do what they want them to do. Right, so you have these congressional hearings. It's kind of one of them where essentially, and what Jamie Dimon from JP Morgan said in that hearing was, what we do in China is we support American firms, right? What would Apple and GM and so on, what would they do, or Walmart, what would they do in China without us? They can't operate. So that was a really interesting thing that you saw that actually popping up as a kind of explanation of why they need to be in China. It's not because of China, it's really because of the American firms. Again, you have a growing list of sanctioned firms in China, especially since the kind of start of the US-China trade war in 2018, it exploded. And you have kind of portfolio investment from the West is also decreasing. So you had this kind of 2010 to 2020 cycle of actually capital moving into China. I mean, $1.4 billion at the peak in 2020 went into kind of Shanghai, into China and Hong Kong, mostly China, because you had these index inclusion and so on. And then kind of rapidly kind of fell off, which It's not quite clear is that geopolitics or the market, because the red line is the CSR 300 Chinese market, and this is basically the market cap of Japan that was lost in that period. And it was really unattractive to go there, especially when you had the Magnificent Seven in the US at the same time. So so if you talk to the Europeans, they were like, yeah, the market was just bad, we didn't invest. The Americans actually had a lot of pushback where pension funds were not allowed to invest into China anymore. And it was very difficult to convince investors of why they should invest into China when there were these political risks coming out of Washington. That is changing, and now they're all looking to go back to China because the market has evolved so well this year. But there's kind of some of the dynamics that we see here. But nonetheless, when Wall Street operates in China, it actually doubled down on China. Right, so these are office locations of the global investment banks, 10 largest in 2011 and in 2022, massive increase. And more important, you see that with the entities that they have in China. Right, so in 2010, have kind of mostly minority partnerships and joint ventures. 2022, you have especially a rise of kind of majority-owned or wholly-owned entities. And even in this period where we have this kind of massive drop in investment, you have way more entities, especially wholly-owned entities, buying these Wall Street banks. I mean, there's interesting differences, right? I mean, Bank of America, they really kind of messed up in a way, right? They weren't very, they didn't work with the regulators, but actually tried to work against them. And then the license, and then they left China, the regulators lost face, and then they can't get the license back anymore, even though they want to. A good example for this is JP Morgan, right? Since 2020, they now have full control of 3 different joint ventures. They operate an independent investment bank, futures broker, and asset manager. They have 4 times as many licenses for products and services they can provide. They've doubled their workforce to more than 1,000 employees in China's largest skyscraper, the Shanghai Tower. I mean, and I hear things like, well, despite all the geopolitical tensions, the market is just so lucrative to big investors and banks, they cannot not have a presence in China, right? Because especially as China, if it's included into global benchmarks, you have to make up for the difference somehow. And the pension market, right, that's a statement by JP Morgan they made to Bloomberg, right, is that it's one of the biggest opportunities in China because of demographic change and the need for retirement investments. I mean, the numbers here speak for themselves, right? Pension assets to GDP in the US are like 130-something%, less than 2% in China, right? So there is so much room to grow. It's a $1 trillion market that you can't miss out on, essentially. All right, so where does this leave me? So I think Wall Street was quite important in China's economic rise, in helping it to become the factory of the world, to climb up the value chain. I mean, a lot of the acquisitions that they did in 2010s, for instance, were also linked to Made in China 2025. There was, yeah, like this robotics company in Germany, KUKA, and so things like that, and really helped it to build a financial industry that now is actually becoming more important globally, right? So if you look at ASEAN, Chinese companies now actually served rather by ICBC or Bank of China, and that business is increasingly done in RMB and in dollar, right? But they learned this to do this as well from these partners. So I do think that this matters when we think about global capitalism and how we think about the role of Wall Street in global capitalism, right? Because in a way, it does have a deliberalizing effect by enabling China in the first place. And helping that rise of kind of a non-liberal financial empire, and how it kind of reconfigures how we think about states markets. How? That's it. Thank you.
Thank you very much. Thank you, Johannes. Very stimulating, informative presentation. So, begin with questions. Look around the room. And I don't see any hands going up. They're still, I think they're still assessing what you've just been saying. Right.
So how does this fit into the narrative as you discussed? So the narrative is that sort of US companies that the US to West kind of financing the fuel China's rise in various sectors, finance included. And now there's this contradiction because on the one hand, US financial firms can't invest in Chinese tech. There's restrictions around that, but JP Morgan, all the big guys are trying to go to China. They're trying to invest in the pension pots. The government's trying to reform its state welfare system using, So there's a big interest by the City of London, the British government, but also US institutions in going to China, but also with the geopolitics, there is sort of these red lines. So I'm just curious about how do you feel that impacts? Because there's a lot of demand and interest. China wants to work with the West on financial services, but there's these other geopolitical issues at play. So how do we sort of move forward with that, given the influence of Wall Street in Washington?
You want to take questions one at a time or two or three?
We don't have any here, and yeah, I can do them one at a time.
We'll answer that and then.
Yeah. Okay. Thanks. So this is an excellent question. So I think there's two different things. On the one side, I mean, what we now see with these banks is that they're much more cautious about the Chinese activities, right? There's a lot more due diligence, there's a lot more risk assessment and compliance that is being kind of implemented. So to also talk to one lawyer who's basically, especially these compliance law, in all of his cases were basically helping to ring fence the activities of these banks when they operate in China. So that's one thing. And then there's a huge difference between the US banks and other banks. So what we see is that the Swiss banks like UBS really profited from the Americans being able not to do as much as before. So they are probably, together with JP Morgan, the two most important foreign banks in China. And also like Allianz is really bullish on China now, so is Société Générale and BNP and so on. So these European banks who don't have the same kind of pressure from their governments that the US have, Americans have, they are becoming more active here. Really trying to, kind of this balancing act, which is quite fascinating.
Any other questions?
I was wondering as well, if you heard some interviews that basically Wall Street actors changed their kind of activity according to the kind of state capitalist way that it works in China, and if this only impacts the activity of Wall Street actors within China, but also like back on Wall Street.
You come in too, Sandy. We'll take two questions.
Yeah, just a quick one for you, Johannes. I'm wondering a little bit more on maybe Hong Kong's role in all of this. And I wonder if, because of the role it's played historically as kind of an offshore financial center, whether Hong Kong doesn't allow China to have its cake and eat it as well in terms of the deliberalizing effect. Like, can it operate through Hong Kong and liberalize global capitalism?
Excellent, thank you. So I had this really interesting, when I do these interviews, I also probe them like, okay, but what do you do with the Chinese state? I mean, there's so much regulation and so on, doesn't it hurt your business? But yes, you can think of it as a constraint or as an opportunity, because if you follow government kind of cues or guidelines, you can make a lot of money there. So if green tech is where red tape will be cut, where subsidies are available, where companies are allowed to list, because listing is very politicized, and who can list is really decided by the state, essentially. If you kind of follow these cues, you can make a lot of money in the process. So you can work with the government. I haven't seen that kind of reverberating back to Wall Street, right? So, and these are also people, and an interesting dynamic is that one of the most important roles of the management of the Wall Street firms in China was actually to deal with headquarters in the West. Because there was this kind of, they had a lot of translation work to do. Look, this is how things work in China, and this is how we work with that. And the ones who were successful, first of all, they needed, like, the necessary condition was to work with the Chinese regulators, because otherwise you were toast. But the sufficient condition was then to work with your headquarters in a way that they allowed you to do in China what you had to do to be successful. So that would be the feedback if there was one. But I don't see that reflected back on how they would do business in New York. And Hong Kong's role is really interesting in that, right? because it used to be a lot more international, and now it's very Chinese. I mean, I think like 45–50% of the assets in Hong Kong are kind of by Chinese financial firms, which used to be like 20% 15 years ago. And like 70% of the listed companies are mainland companies that are listed in Hong Kong. So, and especially in the last, especially this year, you could actually see the government's rhetoric changing to actually we need Hong Kong to remain Hong Kong, and we need it as a kind of offshore hub, especially for RMB internationalization and so on, because Shanghai can't really do that. So the way I see it is that Shanghai is New York and Hong Kong is London in a way, right? When it comes to the kind of function of those centers for the national financial system.
Right, I'm going to come in with a comment. I'd love to talk in terms of presentation, in terms of the groundwork you've done, Wall Street with Chinese corporations, so on. But my point is about, does this justify the phrase remaking of global capitalism? If we take a synoptic global view, what do we see at the moment, 2025? The world equity and bond markets are nearly 3 times world GDP. The US accounts for 47% of equities and 40% of bonds. Euro and China are way behind in second place with around 10–12%. This then is reflected in the world's largest financial market, foreign exchange market, 9.6 trillion a day. A day. 32 times daily GDP. 88% out of 200 of that is the dollar. Where is the renminbi? 8% out of 200, or 4% more. So can we really talk about bringing China into the remaking of global capitalism? I don't think so. What we have, you're quite right, China is the world's factory. China with 1.4 billion people, 800 million workforce. They need foreign markets and they need foreign resource supplies. So the essence of BRICS, renminbi, tie in these through Belt and Road Initiative and so on, tie in foreign markets, foreign resource supplies into China's space. That's the point of internationalizing the renminbi. But it is not about challenging dollar dominance or US capitalism. Let's be clear. China's working down below, production and trade, and the US is upstairs in finance. If we don't get this clear, we are eluding us. So that's a comment. I'd like you to respond. But before you do, is there anyone else with questions?
First of all, there's someone online, and I also have a question.
Okay. Shall we take the online question first?
Yes, thank you. A very interesting talk. Thank you very much. I was wondering, and in a way, in the same vein, but thinking more in terms of insurance policy. So obviously, if you look at the potential to have to decouple faster from the US, then you need, from a Chinese perspective, then you need not only access to international capital, but you need the payments infrastructure. You need a level of internationalization of RMB, and we are seeing some of these attempts in China to have a kind of business continuity infrastructure, and that includes the big securities houses. So we have declarations from the government and from the regulator, from the CSRC, asking the security houses to become to be able to compete with the Goldman Sachs of this world, and to be global investment banks. And we have a big movement of mergers. We have the CBDC, the central bank currency attempt to be able to have cross-border payments much more efficiently. We have the CIP. We have Hong Kong becoming I think global banks in Hong Kong have lost an incredible amount of competitiveness, and then this is where the Chinese investment banks have gained huge amounts of market share. So I would like to hear from Johannes his view on whether this has any potential legs, not so much because it's important right now in terms of the big magnitudes, as the previous speaker mentioned, but if it could work if necessary.
Inga, and then back to Johannes.
Yeah, I was just wondering, and I know this is not really a project here, but are you thinking about how to categorize this as a regime? You mentioned in the beginning, there's of course liberalization and then re-regulation possibly. We still have capital controls in place. So it's such a crazy but super interesting conglomerate of different elements of regimes that we obviously, I mean, that's to be expected to some extent, but as a comparativist, I kept thinking how amazing would it be if you could, describe this in comparative ways, like what is this and how does it kind of border on liberal market economies, coordinated market economies. You mentioned some dynamics similar to the changes that have been taking place in German financial markets.
Johannes, response.
Thank you. I mean, first of all, I totally agree with your assessment of where China is in the global economy in relation to the US. And I would argue that, I mean, what we see when it comes to finance, they do not want to replicate the American model or challenge the US. It's really much more about gaining autonomy, especially in an environment that's increasingly hostile towards China, right? I mean, and this started back in the 2000s already when it came to kind of commodity pricing, which was kind of a big issue where they suddenly realized, oh, we're not just import of commodity, but actually we really can influence the price and we pay premium for oil and so on and so on. So essentially a lot of these developments were really about kind of creating a more resilient financial system against external shocks. And the functional finance is a different one in China as well, right? I mean, as it's very often noted by the government and regulators, it's about serving the real economy. And you see that as well, because these things like IPOs, M&As, that's something that is quite tangible, right? In terms of, yeah, this does serve the real economy. Now have more less wasteful companies actually have market share and can defend that and so on. Or we can kind of steer money, kind of steer markets as an allocation mechanism that's somewhat efficient, maybe, towards kind of certain strategic objectives, right? Like certain industries that we want to push. But that is and for that you don't really need a Goldman Sachs, but you need a bank that is able to do an IPO. I think there is a lot of rhetoric about challenging the kind of building, I think, aircraft carrier-sized investment bank. That's the term they often use. I do think they want large investment banks, but it's rather about not having to rely on the Goldman Sachs of this world when facilitating these operations in Malaysia and so on. I think this is rather where it comes from. So it's a very different way of finance, and it's maybe also kind of less inflated than the dollar system, if you will. And yes, I mean, the remake of global capitalism, I'm still playing around with titles, so I'm not quite sure if it works. I think there is a story about global capitalism in there and China's role and what's its role, and how we have to rethink how we tell its history based on knowing more about the relationship. But yeah, remaking is probably not the right way. So any suggestions, I'd be very happy about.
I'll give you them in the pub.
Excellent. And yes, I mean, this also spoke to some of the comments made by Martina as well on kind of, I think RMB standardization has exactly this function, right? So I was at the kind of China Day of the Euro Finance Week a few weeks ago, where you have this kind of whole day about kind of China and those HSBC, ICBC, and some of them were there, also the heads of RMB internationalization, some of the kind of German banks were operating in Asia, and like they were all kind of saying the same thing. Corporate banking is the main driver of RMB internationalization in ASEAN. It's that firms like BYD or Capital, or the green tech firms are now much more central in supply chains rather than just being suppliers themselves, and do their dealings with their suppliers, be they from Malaysia or Indonesia and so on, in RMB rather than dollar. And you need and what you have now is a framework or an infrastructure that is able to facilitate that through the clearing banks that were established. You have the central bank swap lines as kind of backstop towards that. You have the CIPS payment system, which now also increasingly includes non-Chinese banks abroad. Right, so all these Wall Street banks, their China operations, they're all direct members of the cross-border international payment systems by China. But now HSBC, Standard Chartered, and Standard Bank, the largest bank in South Africa, are also direct members now. Right, so and there's a kind of this process that's taking place. And I think a lot of what we see in terms of the internationalization of the RMB is really geared towards this kind of serving the real economy role, helping Chinese companies in their international operations. And I think this is something that is already working, because they've been laying the groundwork also for doing trade in RMB and so on since 2009, basically, with the first kind of and how to categorize this as a regime, I'm really not sure. I mean, I used to talk about this as kind of state capitalism when I only looked at China, but I think it's more complex than that. If we really take Wall Street's role seriously, there is something that's more hybrid, but I really can't put a finger on it yet. Hopefully at some point.
Right. You and then.
So, Raphael. So this week, China made the headlines for breaching that 1 trillion trade surplus mark for the first ever time. Now, whether it has the express volition to overtake the US and not as the dominant reserve currency in the world, it seems through trade, it is certainly edging up there, right? So do you see a future where the renminbi does become a very dominant currency in the world? And what timelines are we talking about?
For you, yes. The answer is no. All real world transactions at the moment account for 5% of the 9.6 trillion turnover debt. 5%. That's FDI, trade, you name it. The other 95% are finance-related transactions conducted by banks and non-bank financial institutions. And this ratio of 5% is in decline, just as the volume of turnover in the foreign exchange market is increasing. That is the trend, and it will continue. You, what's your name?
My name is Tam Bizon. I work at Burton Road.
All right.
To London, into China. Not bad. So your opinion is quite interesting. Do you feel when Donald Trump visits April to conclude his deal for rapprochement with China, that American firms and family offices, apart from JP, will return to China rapidly or use London or something like that as a base to de-risk from future change of policy? And what role has Saudi Arabia and the GCC banks and investments in the last 3 years, not in terms of renminbi internationalization, but in securing China and creating a new relationship that would, in the medium term, insulate them from President McKinley from the 1890s, who's doing his tariffs, which he was copying?
Johannes?
Yes, thank you. I also agree. I mean, within this 5%, China is becoming more important. That's only 5%. Right? But if you look at some of the bilateral current payments of China with other countries, especially its main trading partners in the global south. A lot of them increasingly use RMB when they trade with China, right? So the US doesn't, Europe doesn't. So if there's bilateral trade between Europe and China, it's basically in euro or in dollars. If it's between the US and China, it's in dollars. But if it's between Thailand and China, it's 50% in RMB already. And that's data from, there was kind of an IMF paper from 2 years ago that has that data, which is fascinating. And this is basically SWIFT messaging data on kind of trade transactions, essentially. So I do think what we will see is that the RMB is becoming more important when it comes to kind of these more regular transactions, but not the more kind of financialized part of the story. So I do think it's important. I mean, what kind of yardstick we use to compare China with the US, right? I mean, China's attempt, I mean, dethrowing the dollar would mean for China to really go financialization all the way, right? And that's not what I want to do. And also, yeah, it's not about challenging the dollar, it's really about maintaining, enabling kind of regular transactions to flow without interruption or intervention. And that we're seeing especially with the main partners, increasingly. And I think what we saw is that increasingly US investors are returning to China, especially this year. I mean, some of them never left, some of them have increased their business in China. So I do think we see that happening. They are becoming more active in Hong Kong again, even though they lost market share. They try to do a lot more from Singapore and realize, oh, this is actually not working. We want China business, we'll do it from Hong Kong. So there is a kind of a relocation back to Hong Kong, more important again. Also because they might not want to be in the mainland for regulatory reasons or whatever. But I do think that is something that we are seeing, have been seeing over the last year. The relationship with the GCC is super interesting, I think, because this is something where we see a lot of interaction. And even if we look at the level of kind of these industry events like the Asian Finance Week or Abu Dhabi Global Markets Week, there's way more Chinese actors in Abu Dhabi and another way around. And way more kind of transaction flows as well. You have kind of China buys essentially have investment by the sovereign wealth funds in China, which were some of the largest investors in the last 2 or 3 years. So Mubadala and PIF and so on, they've actually invested quite large sums in China, also Saudi Aramco and so on. And in reverse, kind of China's investing way more in these countries, right? Building out kind of AI and e-commerce or green technology. So you definitely have a much stronger kind of relationship, which I think is also reflected in the UAE joining the BRICS and so on.
Do you think London would be a potential location for American funds who would want to protect themselves from future risk from their own government as they re-enter China?
Yes, I think that's plausible. Yeah. Because if they had to decide for one location globally, beyond New York, it would be London, I think.
Thanks. Anyone else? Yeah? What's your name?
Yeah.
Leanne.
So with all that you have mentioned, specifically about IPO expertise and the global capital market integration, would you still say that Wall Street used China more than China used Wall Street?
That's an interesting question, isn't it?
Yeah.
How are you going to deal with that, Johannes?
I think it depends on, they both benefited in their own ways. I mean, Wall Street made a lot of money by being in China, by making all these transactions. I don't think they used it. I mean, they used it to make money, but they were never dominant, right? I mean, it's very different from Big Bang here in London, where basically the British industry was kind of non-existent after 10 years. It was basically all American and European firms, especially American ones. So it's not that kind of process. They did make a lot of money in China, but China, I think, got in a way more out of it because they were able to build a financial industry. They have these kind of spillover effects into the real economy and never lost control over the process.
Yes, I think
Yeah, come back.
it's more on the research side. Because what do you think is the biggest misunderstanding or bias, if you will, that Western analysts have when they evaluate China's central bank?
Evaluate the central.
China's central bank.
While you're thinking about that, let's bring him in. And then,
Also in relation to the kind of remaking of global capitalism, I was wondering what the main lessons are basically for other emerging markets to basically liberalize their capital markets, and if the Chinese experience is somehow replicable or actually unique. And if so, what are the main components of the capital market liberalization that may be the most contested?
a comment on that issue. If you take all EMEs bar China, their share of global capital markets is about 4%. And it stayed the same in recent years. China, as pointed out earlier, has expanded its equity and bond markets, although in semi-controlled form. The EME markets collectively, globally, stagnant. In fact, in terms of percentage share, they're going backwards. Because they're small, the cost of financing is huge, risk adjusted. Because the cost of finances is huge, it constrains. And that the clearest expression of that is during the 2 years of COVID. Every other government, including China's, issuing more bonds to bail out their economies. The governments of the EMEs, because the costs were so high, they could not issue bonds the way the US was, Germany, and so on. So the EMEs are really a class apart in terms of the constraints and so on compared to China. Sorry,
No,
I don't want to.
not at all. No.
Anyway,
A really good question about the PBOC and the bias. I'm really not sure, to be honest. It's not an area I've really looked into that much, and I haven't really talked to people who work on the central bank policy directly about it. So I could only speculate at this point. But it's an interesting question. I'll keep it in mind for next time I'm going. It's really interesting. Thank you. And about other kind of, it's interesting because I talked to quite a few people at the kind of New Development Bank, right, at the BRICS Bank in Shanghai, and they're from kind of from all these other emerging markets, and they're super interested in, okay, what did China do that we didn't do? Because it seemed to have worked out so well for them, I mean, comparatively. So there is definitely kind of an interest in learning about that. Also, I mean, definitely in India, definitely in Brazil. And I think the capital market story is, yeah, I mean, they're not important enough. But there are growth markets, right? So there is kind of an integration of kind of global finance going into these markets increasingly, in India, for instance, right? Especially in the last years. And one thing that China always did is they did maintain control over the entities. India is doing that a little bit in that you do have a few joint ventures in the asset management space and so on, but it's not as systematic as it was in China. So, I mean, the whole Jane Street debacle, right, where basically did whatever they wanted in India. And I mean, now they were fined and so on. So there is kind of a certain pushback. But I think in China, it was never open enough to allow for these things, right? So I think in Korea, you saw that as well, that there was some pushback against kind of Western trading behavior, the Citadel being fined and so on. But yeah, I think for China, the timing was just different. They had this kind of stock market pressure in 1995, which was basically where some Chinese brokers, basically a hedge fund, wanted to short the government bond futures market. So essentially, well, not essentially, but basically similar to George Soros here in the UK. And he actually had kind of overpowered the state-run asset manager that went against him. And that was the point where basically the government said, okay, this is enough. We'll do this differently. The last 7 minutes of trading are invalid. You're going to jail for the next 25 years. You guys are all losing your jobs. You're going to jail. You're going and so on. And then they kind of revamped everything. So they experimented with opening up, and it kind of escalated really quickly, really terribly. I think it was one of the main reasons why. And then you had 2 years later the Asian financial crisis, which was another kind of warning signal for, and then dot-com bubble and so on. So I think China was just, they opened later what everyone had already opened, and they learned from the process as well. So I don't know if it's replicable in a way. Plus, it is so large that everyone accepts these rules, which are very different, as long as it's profitable.
Anyone else who hasn't spoken?
Yeah, I guess my question is maybe a little bit related to this. And I know that you said that you want to move on from this framework of state capitalism and whatever, but I want to bring a little bit of the state back because the story is very interesting, but it kind of gives the impression a little bit that Wall Street came to China learned from Wall Street, and then it's kind of a happy marriage to some extent. Every marriage has kind of ups and downs, whatever. But I still wonder because according to let's take theoretically, according to a loanable funds model, right? There's competition for capital within China, and China has specific policy goals, right? And then if a lot of this capital is absorbed by stock markets or these kind of actors that you mentioned here, it might clash with the policy goals of China. So I wonder, throughout this time, did China have a specific policy regarding developing stock markets, and then what the limits of that were? And I suppose, there's a lot of overinvestment, I guess, in specific sectors in China, maybe EVs or whatever, mortgages, whatever. But so what's kind of the interaction? Is there a tension between this kind of stock markets and state policy goals?
Yeah, that's a great question. So I think there's kind of several aspects to it. I mean, if I was pressed for it, I would probably say kind of state capitalist, but it's a changing state capitalism. But it hasn't been fundamentally changed from what we've been there. There's something that is changing that's not quite captured by how it's usually defined. If I had to probably go back to using state capitalism as a concept. And what you have in the organization, so markets always had to kind of serve certain policy goals, right, in China. And these were sometimes conflicting. You had there was this emphasis on serving the real economy, which also led to kind of, in a way, suboptimal allocation of resources, right? So one good example is there's Apple futures in China and red dates. And why is that? Is the only red date futures in the world? What's that about? Well, there was a poverty alleviation campaign in the 2010s that was important, right? And it was a KPI for party members to contribute to that. All the kind of management of the kind of exchanges also were party members, and the Zhengzhou Community Exchange was like, okay, what can we do? Well, there's all these poor farmers in Xinjiang and Gansu, and what they do is they plant jujubes. So maybe we give them a hedging tool, and then they can hedge their risk, and they will make more money, and we'll subsidize this and do what we call insurance plus futures. So basically, you can trade for free, don't have any risk. And then that's how the market developed. To actually have an impact, I don't know, but that's kind of a very different logic behind it that's created this market. On the other hand, you have this kind of, we need to reform our companies, and need to be less wasteful. We need them to kind of access capital. And then you had all these kind of companies which really performed very badly because everyone was able to access capital. And now we need to do more for investors because also we want sort of pension reform, and this should not only be a capital raising market, actually, it's an investing market. So there was a pushback against that, and was delisting of firms and so on. And then there was something about retail investors, which would, in a way, had to participate because of the social contract, essentially. But they also create a lot of volatility, and then you need to professionalize them, but also protect them from the foreigners or more professional investors. So there's all these different conflicting objectives that informed how the market was organized. But it was never really the objectives that we have in our markets, which are ways. We want efficient outcomes, and we do that by allowing private actors to make a profit. And the state kind of is the framework of that set. So yeah, does that answer your question?
Johannes, the main thrust of today's presentation is, of course, the penetration from Wall Street and so on, and the influence of China and so on. But you haven't said anything about the influence of other Asian capitalisms in China, because from the 90s, you had the SEZs established, 5 of them, where you have South Korean, Japanese, and even Taiwanese corporations operate. So during the 90s, we had Asian capitalism, which went bust with the Asian crisis, but no one has ever spoken about Chinese version of capitalism because of an amalgam of all these Asian corporations in the SEZs, plus the influx from Wall Street and so on. But the question is, how much influence do you think came from other Asian corporations located in the SEZs, the special economic zones?
Yeah, that's a great question. I mean, I talked to some of the kind of Japanese banks, right? Taiwan, Nomura, who were there to support the companies as well, and it seemed that they were always very. It was for them much easier to operate in China and work with the Chinese regulators than it was for the Americans. And they never had this issue of translating to the headquarters, right? Because you had the developmental state and all the legacies of that in these other countries. So in a way, it was, the gap wasn't as wide that they had to bridge in a way when operating in there.
There's one more question on the Martina.
Okay. Who is it?
Martina?
Yes, sorry, it's still me. No, I was listening, and we are speaking a lot about liberalization, and I wonder if that was the right word. I don't think China has liberalized that much. It has opened up to an extent, but all the key tools in the market remain in state control. Yeah, so you have a totally different way of operating, and so, and I think it confuses the debate when we speak about liberalization. Even the stock market. The stock market is incredibly small compared to the size of the economy. Yeah, so market capitalization in China is a fraction of what market capitalization is in the US or in the UK or even in Europe, which is already much smaller. And the free float of many companies is also very, very small. I mean, and I think then, confusing opening and liberalization makes the analysis much more blur. I don't know if Johannes feels that way or how he will react to that. Thank you.
So excellent. Thank you for the question. I mean, I think actually I looked at this recently. Stock market capitalization to GDP in China and in Germany is actually quite similar. So I think it's like 60, 70%, something like that. But it is.
Oh, it has improved then since I last look at it. Yeah, thanks.
Yeah. But I agree. I mean, liberalization is tricky. I mean, it has opened up. It has liberalized in certain ways, but it's not liberal, if you will, right? I mean, it took a few steps. But it's, and it does. And markets do play a larger role in resource allocation, but they're managed by the state, if that makes sense. But I think, I mean, liberalization, I agree, is not the right term probably to talk about this. Yeah. So, thank you.
I think we should thank Johannes for a very, very interesting. And, you know, and hopefully some of you we're going to go and have a drink after this. Hopefully you can join us in the day labs. But in the meanwhile, can we give a warm round of applause to Johannes for an excellent presentation.
Send me the recording.
Yeah. And when I show up in Teams, and then hopefully it's shareable. Yeah.
It's